Let's talk about the inflation figures. You're pretty happy with those figures yesterday. Would you have liked to have seen it be a little bit lower? And I have been discussing this with Ed. It doesn't take into account the Black Friday and Cyber Monday sales we just had. Does that matter all that much?
Well, it shouldn't, because Black Friday and Cyber Monday sales mean lower prices, which, if anything, and if people are hanging out for lower prices, then that's a sign of weakness in the economy. And I think that's consistent with other indicators from retailers, for example, that they're having to discount more now. And of course, if they are discounting through those sales, and it seems as if they were because I bought some things through it, then that means more downwards pressure on inflation. I was actually quite happy with those numbers. Our expectation was 5.2%. We got 4.9%. Looks like the downtrend is resuming. We did have some very high numbers at the end of last year. November was 0.9%. December was 1.5%. So it's the way the 12-month ended annual rate works, is that those numbers will drop out. Those very high numbers at the end of last year will drop out of the annual calculation. So even if we just sort of average something like 0.5 positive for the next couple of months, and don't forget October was actually minus 0.3% in the month itself. If we just average, say, around 0.5, we'll be down at around 3.5% inflation, or at least inflation will have a 3 handle on it by the end of the year, which is actually good news. So, yes, I think we are going in the right direction. I understand the Reserve Bank's concern, but they don't seem to be as urgent about it as they were going into the last meeting. And so my feeling is that, things are panning out okay. I mean, rates have gone a lot higher than I would have thought. And we do have those recession risks still hanging over us as the lagged impact of rate hikes comes through. But on the inflation front, we're seeing good news.
So long story short, you think the interest rate hikes are over, not just for this year, but for next year as well?
I don't see a rate hike next week. I think that's very unlikely. There's been no smoking gun for that. Soft retail sales, softer inflation numbers. I think we're also going to see some softening in home price data when that comes out in the next day or so from CoreLogic. Next year, I think there's a 40% chance of a hike around February or March, but our base case is that we've seen the peak. And as we go through the year, we'll see slower growth, slower inflation, and ultimately that will enable the Reserve to start cutting later in the year.
Fiscally, I know this is a bit of a stitch up of a question and a big question for you to answer, quickly and concisely, but what should the government be doing?
Well, the government should be doing a bunch of things. One is saving more money. I mean, I know we're in a surplus, but now's not the time for more government spending. It's the time for taking any extra increase in revenue and certainly saving that, and also finding ways to cut back, which of course is what they've been doing lately in terms of infrastructure. So that's the right thing to do there. And in terms of other things, they should be working on ways to improve the supply side of the economy. Labour market deregulation, not re-regulation, tax reform to encourage more work effort, more reliance on the GST, but yes, with compensation for low income earners and those on welfare, and also competition reforms, I think, is a big one as well. So there's a bunch of things the government should be doing, but I think it really, ideally, we need a reinvigoration of the economic reform agenda that we've seen in the past, to reinvigorate the supply side of the economy. But in the very short term, there's not a lot the government can do apart from maintaining relatively tight fiscal policy, or perhaps ideally a little bit tighter than it is now.
Right, got it. Shane, thanks so much. Always good to talk to you. We'll see you soon.
Likewise. Thank you. Thanks, Laura.